Now only I have done equity, debt to equity, that is debt to equity we have done. Now there are some more ratios. We have to find out what is proprietor ratio, total proprietor ratio, interest coverage ratio. Fine, that we will try to find out with one simple problem. Fine. So now take, given here, given is the balance sheet. Okay. Now shareholders fund. Shareholders fund. Now shareholders fund is 4 lakhs given to us. Then reserve and surplus. Reserve and surplus 1 lakh is given to us. Then non-current, yeah. So I will tell you the format when I am doing the balance sheet. Long-term borrowings. Long-term borrowings. That is debentures, long-term. 1,50,000, bank loan or debenture, anything can be there. Then you have current liabilities. Current liabilities 50,000. So total is 7 lakhs for us. Now assets, go to your assets, vertical balance sheet only. Here you have non-current assets. I'll make it clear when I'm doing company account with comparative, common size and all, like this only it should come. Now you have plant, fixed asset they have told, but it is plant, property, plant and equipment, fixed. Till we have not changed in the books. When we are doing company accounts, this is also known as plant, PP, plant, this one, property, plant and equipment. PPE will call us, property, plant and equipment. So 4 lakhs are given to us. Then non-current investment. Non-current investment 1 lakh is given to us. Then current assets are 2 lakhs. So total is 7 lakhs given to us. Okay. This is the balance sheet which is given to us. Now they are telling us to calculate, one is a debt equity ratio. These are all solvency ratios, B, proprietor's ratio. Proprietor ratio. I'll tell you what to be taken in proprietor ratio. Then debt to capital employed. Debt to capital employed. Debt to capital employed. Then percentage is not given. Interest coverage I will do in the next problem for you. So these are the ratios which we have to find out. So debt equity we have found out now. What is the formula for debt equity? Long term with shareholders fund. First one, solution. So debt equity. Debt equity or debt to equity. Okay. Debt to equity it is. So debt divided by equity. Or shareholders fund you can write, So here it is how much? Debts are how much? 1,50,000 divided by equity, shareholders fund 5 lakhs. Shareholders plus your reserve and surplus put together. So what is that? Debt equity. So shareholders fund, equity is nothing but this is shareholders fund. In that shareholders, reserve and surplus put together will come. 5 lakhs will come. Now tell me how much you get. 1,50,000 divided by 1,50,000 divided by 5 lakhs will give you 0.3 is to 1. 0.3 is to 1. Correct? This you can write. Next one, proprietors formula. Please write proprietor ratio. Proprietor ratio is shareholders. So proprietor, shareholders fund, shareholders. Formula of proprietor is shareholder fund or equity divided by capital employed. This is our formula, or it is also known as net assets. This is the proprietor ratio, common, huh? So take shareholders fund divided by capital employed, that is nothing but net asset you get. What is shareholders fund? We have already got it, 5 lakhs. Now capital employed, just see the capital employed. Take the 7 lakhs minus your current liabilities. So capital employed is how much? So take proprietors, capital employed is fixed asset, current asset. So fixed asset 7 lakhs you can take minus this. So what is that? Capital employed. I have already done so many problems. Capital employed fixed asset plus current asset minus current liability will give you. 7 lakhs are there. So fixed asset plus current asset together 7 lakhs minus 50,000 this. 7 lakhs minus 50,000 total. So how much you get? 6 lakhs 50,000. Proprietors. So proprietors is how much? 5 lakhs divided by 6 lakhs 50,000. 0.77 is to 1. Yes. Proprietors formula, see, shareholders fund divided by capital employed or net asset is my proprietors ratio. Please know solvency ratio. Next ratio is debt to capital employed. Debt to capital employed we have taken. Debts is how much? We have taken, no, debts are how much? 1,50,000. So please see this. Okay. Now therefore, debt to capital employed. So here debt is your, we know, 1,50,000 divided by capital employed 6,50,000. Correct? 1,50,000 divided by debt to equity. How much you get? 1,50,000 divided by 6,50,000. 0.23. 0.23 is to 1 you can write down. Yes. Clear, students? This is now proprietor ratio we have covered, debt to equity we have covered, and then we have debt to equity and then debt to capital employed we have covered. So solvency ratios are covered. Interest coverage ratio, that I will take. Interest coverage ratio in the next problem I will take. One more problem I do, then I will wind it up. So ratios are, so many ratios are enough, go through that, more than enough it is.